taking that all into consideration, again, let's get back to the basic valuation equation. We can take dividends or earnings per share or EBIT or EBITDA per share or net operating income and divide it by some type of income capitalization rate or some type of expected return or some kind of discount rate to get the valuation. This is the perpetuity model. It's very simple, but what you can see is you have a numerator, income, and you have a denominator, the expected rate of return, either on the equity or the discount rate or whatever you want to call it. I have found out that over the years that it's fairly easy to forecast dividends and earnings and free cash flows and net operating income because it's highly correlated to the business cycle. And the commercial real estate cycle is highly correlated to the business cycle. So if you know where we are in the business cycle, you know where we are pretty much in the commercial real estate cycle or the real estate cycle. And you can forecast where we're going to be in the future over the next 3 to 5 years. So the numerator, if you know, is fairly easy to spot and fairly easy to forecast. What I believe is extremely difficult to forecast now is the discount rate. What is the discount rate? And I'll go through decomposing what the discount rate is in a minute. But what I found over the last 15 years, since really 1994, 1995, is that the volatility in the discount rate has now been exacerbated. And if the discount rate is more volatile, then that means the values are more volatile. The net present values, the present values of the internal rates of return are more volatile. And if discount rates are more volatile, then it makes it harder to make investment decisions. The other equation is the discounted cash flow. And again, as you can see, it's the net operating income, the terminal values on the end, but it's really the volatility comes from the growth rate expectations and the discount rate. So volatility and values really emanate from changes in growth rate expectations and changes in the discount rate. And I believe that now changes in the discount rate are extremely more volatile than they've ever been historically, which again makes it hard to make investment decisions. And in this case, I used the capital asset pricing model as the proxy for the perpetuity discount rate and the discounted cash flow discount rate, which is theoretically correct. So what is the discount rate? So I went through and I decomposed the discount rate. Well, if you're going to build the discount rate to discount cash flows, what's the base rate or the first rate that you would use? You would use the risk-free rate. What is the risk-free rate? It's the real rate plus inflation expectations. You also have to add a inflation risk premium because maybe it's just inflation expectations, but inflation now, if you go back to 2000, you can really see the volatility in price indexes. So we have a higher inflation risk premium that needs to be added onto that discount rate or into the discount rate or onto the base rate. Credit risk premiums, those are probably one of the most significant risk premiums in the discount rate calculation. If you're a small cap firm, you have higher default risk, higher bankruptcy risk. If your bonds start to default, if you're BBB, BBB, you issue BBB, BBB bonds, there's going to be a higher risk premium that needs to be embedded in the discount rate. Illiquidity risk premium, your stock and or your bonds, if you're a smaller firm, are not treasuries, which are highly liquid. They're probably going to be illiquid. So the investor may want to liquidate their position. They may not be able to liquidate their position because there's not a ready available market for their stock or their bonds. So you have to include an illiquidity risk premium. Maturity risk premium. Longer term bonds are more sensitive to movements in interest rates than shorter term bonds. So depending on the maturity, will have a direct impact on the risk premium, again, that needs to be embedded into the discount rate. Currency risk premiums. If you are a firm that sells into the foreign markets or exposed to foreign markets, there should be a currency risk premium embedded in your discount rate because you will be affected by changes in interest rate in currencies. Tax risk premiums. This became very important last year with the changes in the capital gains tax, income tax, Obamacare, added tax to, a higher tax to a lot of individuals, and the corporate taxes are coming. So you had to, and taxes are gonna change in the near future, so there needs to be a tax risk premium embedded in your discount rate. The last two risk premiums, which I believe had not really been taken into consideration, but are obvious now, are both political and policy risk premiums. Political risk premiums are really reflected in the bifurcation and really the binary adversary environment currently in both the House and the Senate in Washington, D.C. You have the Republicans that control the House and the Senate, but only on the margin, and to pass comprehensive centrist policies right now through the political process is extremely volatile and extremely hard. And the inability to have a stable political environment and process that leads to centrist policy, it hurts businesses and individuals because they cannot plan. If you have parties that are fighting against each other and policies that are redistributive, are not centrist, are not equitable, that go to certain privileged groups within the society that have political power, you're going to have a distortion and a redistribution. The economy is going to operate at some kind of Pareto optimal output or outcome. So I believe that political and policy risk premiums now need to be taken into consideration, factored into the discount rate. And if these are very volatile, then that means your discount rate is volatile, which means your present values are volatile, net present values, and internal rates of returns are volatile, which again makes it very difficult for financial investment decision making. And that's probably why we have seen over the last 7 to 10 years an underinvestment by individuals and corporations into the economy, because the political policy risk premiums and the volatility are too extreme, and it's too hard for them to make investment decisions or consumption or even savings. So the economy is not operating as it should. And the last 4 years is a good example. We just went through a 4-year recession. Most recessions last 2 years. This was 4 years. A lot of it was, a lot of people were in cash. They didn't want to be in stocks and bonds, and they didn't want to invest because they felt the environment was too risky. So let's end it there.